The Corporate Predator, The Life, Philosophy, and Battles of Carl Icahn. Good morning and welcome. In our ongoing exploration of the masters of finance, we have studied philosophers of the market, architects of portfolios, and disciplined traders. Today we turn our attention to a different kind of titan, one who does not simply buy and hold companies, but who actively, aggressively, and relentlessly seeks to bend them to his will. He is not a passive owner. He is a corporate insurgent, a guerrilla in the gray flannel suit. He operates not in the quiet halls of academic theory, but in the brutal public arena of proxy fights, hostile takeovers, and boardroom coups, where reputations are shattered and fortunes are won in the glare of the media spotlight. He is a force of nature who has fundamentally reshaped the landscape of American corporate governance, for better or for worse, leaving a permanent mark on the very definition of a corporation's purpose. His name is Carl Icahn, the original and most famous activist investor. For over half a century, he has waged a relentless personal war on what he derisively calls corporate fat cats and entrenched imperial managements, amassing a colossal fortune by targeting underperforming, complacent companies, taking a significant stake, and then using the raw power of his capital and his formidable will to force radical, often painful change. His story is a gripping saga of financial engineering, bare-knuckle tactics, and an unshakable belief in his own right to demand value from those he sees as stewards of his capital. He is, depending on your perspective, either a champion of the shareholder, a necessary corrective to corporate waste and sloth, or a corporate raider whose short-term mercenary demands can eviscerate a company's long-term future and cripple its innovative spirit. To understand Carl Icahn is to understand the raw, unapologetic power of concentrated capital and the eternal, often bloody, tension between ownership and management in the public corporation. Part 1. The Making of a Raider, from Princeton to Wall Street's back alleys. Carl Celian Icahn was born in 1936 in Queens, New York, to a mother who was a schoolteacher and a father who was a frustrated opera singer and cantor. From an early age, Icahn displayed a fierce, almost combative competitive streak and a brilliant, if iconoclastic, intellect. He was a champion chess player in his youth, a pursuit that honed his strategic thinking, his patience, and his ability to think several moves ahead of his opponent, to visualize the entire board and force a checkmate through relentless pressure. This would become the defining metaphor for his career. He attended Princeton University, where he studied philosophy. It is a fascinating, telling detail. The abstract reasoning, logical rigor, and deconstructive nature of philosophy would later underpin the precise, devastatingly logical arguments he would wield like a scalpel against corporate boards in his famous letters. After a brief, abortive stint in medical school, which he abandoned finding it lacking in intellectual combat, and a tour in the Army, Icahn found his way to the proving grounds of Wall Street in 1961. He started as a lowly registered representative, a stockbroker, at the firm Dreyfus & Company. He was not a natural, gregarious salesman. In the traditional sense, he was too blunt, too argumentative, too impatient with small talk. But he possessed an incredible autodidactic talent for understanding the complex mechanics and levers of the market, particularly the intricate mathematical world of stock options. He quickly realized that the real money, the real power, and the real intellectual challenge was not in brokering trades for others, but in deploying capital for oneself, in making bets where you controlled the thesis and the outcome. In 1968, with $200,000, a significant portion of it bravely borrowed from his uncle, he founded Icahn & Co., a small, scrappy brokerage firm focused on the high-stakes arenas of options trading and risk arbitrage. This was the gritty, unglamorous, and intellectually demanding back alley of finance. It was here, in the pressure cooker of betting on the outcomes of mergers, tender offers, and corporate events, that Icahn developed and honed his core skills. He learned to dissect corporate balance sheets and legal structures with surgical, predatory precision, searching for hidden value, for latent assets that were being mismanaged, undervalued, or simply ignored by a complacent establishment. More importantly, he observed a pattern. He saw that many large, publicly traded blue-chip companies were, in his uncompromising view, profoundly inefficient and poorly governed. They were run by complacent careerist managers who were more interested in expanding their empires, enjoying their lavish perks, and protecting their prestigious jobs than in maximizing value for the people who actually own the company, the shareholders. This insight was the genesis of his entire life's work and philosophy. He came to believe that the stock market was not a perfectly efficient pricing mechanism, as academics claimed, but a place where tremendous value could be locked away, imprisoned, inside poorly managed corporate structures. The key was to find a way to pick the lock, to force the door open. And the method he pioneered and weaponized was corporate activism, or as it was known, feared and celebrated in the go-go 1980s, corporate raiding. He wasn't just an investor, he was a liberator of capital in his own eyes. Part 2. The Arsenal of Activism. The Playbook of a Corporate Guerrilla. Carl Icahn did not invent the concept of shareholder agitation, but he perfected it into a ruthless, repeatable, and psychologically devastating playbook. His approach stands in stark contrast to the Buy Wonderful Businesses school. His strategy is to find mediocre or good businesses trapped in terrible corporate governance, and then to become the catalyst, the explosive charge necessary to shatter the status quo and realize their latent value. His entire campaign strategy can be broken down into a series of distinct escalating phases of conflict, each with its own weapons. Phase 1, the hunt and the stealthy accumulation. The process always begins in the shadows with intense, secretive forensic research. Icahn and his small, loyal team would scour the market for what he termed the fat and happy company. The ideal target had a specific, vulnerable profile, a stagnant or declining stock price over years, a strong balance sheet with plenty of cash or undervalued hard assets, like real estate, oil reserves, or a pension fund surplus, a fragmented shareholder base with no controlling block, and most importantly, a management team and board that appeared complacent, out of touch, and more focused on maintaining the corporate country club than on driving returns. Once a target was identified, Icahn would begin quietly, patiently accumulating a significant stake in the company's stock, often using complex options and derivatives to hide his size and intent for as long as legally possible. This stealth buildup was crucial. It allowed him to buy his position at a lower price before the market anticipated the coming storm, a classic asymmetric information edge. Phase 2, the public declaration, the bear hug. Letter. Once his position was large enough to command attention and cross regulatory filing thresholds, typically 5% or more, the quiet phase ended with a thunderclap. Icahn would launch his overt attack with a weapon that became his literary signature, the public, meticulously crafted and brutally scathing bear hug letter, addressed directly to the company's board of directors and immediately filed with the SEC for all to see. These letters were not polite suggestions or friendly shareholder queries. They were formal declarations of war, masterpieces of financial rhetoric and psychological intimidation. They would meticulously lay out the damning case against the current management, detailing their strategic failures, highlighting the chronic underperformance of the stock, and juxtaposing lavish executive compensation with poor returns for owners. The letters would then demand specific, immediate, and often radical actions, spinning off a valuable but overlooked division, selling the entire company to a strategic buyer, initiating a massive leveraged recapitalization or stock buyback, slashing bloated overhead, or outright firing the CEO. The letter would always contain the core threat. If the board did not comply and engage with him in good faith, he would wage a costly, embarrassing proxy fight to replace them, or he would launch a tender offer to buy the company himself, often with the help of high-yield junk. Bond financing pioneered by allies like Michael Milken. Phase 3, the proxy fight and public campaign of attrition. If the board resisted, which, viewing him as a barbarian at the gate, they almost always did, the battle would move into the public square, transforming from a financial dispute into a full-blown media and legal war of attrition. Icahn is an undisputed master of public relations, legal maneuvering, and psychological warfare. He would take out stark, full-page ads in the Wall Street Journal and the New York Times, directly appealing to his fellow shareholders over the heads of management. He would give incendiary, memorable interviews on financial television, painting the CEO and board as a group of overpaid, clueless bureaucrats who were stealing from the shareholders. He would file a barrage of lawsuits against the board, alleging breaches of fiduciary duty and corporate waste. And he would nominate his own slate of directors, a shadow board, often including himself and his trusted lieutenants, to stand for election at the company's annual meeting. This process, a proxy fight, is a brutal, expensive, and deeply personal corporate civil war, where both sides spend tens of millions mailing pamphlets and making calls to woo the often passive institutional shareholders who hold the deciding votes. Phase 4, the end game. Green mail or transformation? The confrontation historically ended in one of two archetypal ways. In the 1980s, a common and controversial outcome was green mail. This was a practice where the targeted company, desperate to rid itself of the raider's destabilizing presence and avoid a proxy fight, would agree to buy back his entire stake at a significant premium to the current market price. Icahn and other raiders like T. Boone Pickens made staggering fortunes through green mail, effectively being paid a massive ransom to go away and leave management in peace. While hugely profitable for the raider, this practice was widely criticized as a form of legalized extortion that benefited the activist at the expense of the remaining shareholders who did not get the premium. The other, more substantive outcome was actual, forced corporate change. Icahn would either win his proxy fight and install his directors, or the threat would be so severe and credible that the board would capitulate before the vote and agree to implement most of his demands. The company would be broken up, sold piecemeal, taken private, or subjected to a drastic restructuring. Inevitably, these actions, the mere announcement of a sale process, a large buyback, or a spin-off, would cause the stock price to soar, as the market priced in the imminent release of value. Icahn would then sell his shares at a tremendous profit. This is the pure, uncut core of his investment thesis. He is not betting on a company's organic growth or the brilliance of its R&D. He is betting on his own ability to be the unpredictable, disruptive catalyst that forces that dormant value to be realized through sheer force of will and financial pressure. Part 3, the legendary battles, case studies in corporate combat. To truly appreciate Icahn's impact, his adaptability, and the spectrum of his outcomes, one must examine a few of his most famous campaigns, each a landmark case study in the art of corporate conflict. TWA, Trans World Airlines, the takeover and the hollowing out. This was perhaps Icahn's most ambitious, controversial, and instructive raid. In the mid-1980s, he set his sights on the iconic but financially struggling Trans World Airlines. After a fierce multi-front battle with the board and a rival bidder, Frank Lorenzo of Texas Air, he took control of the company in 1985. Initially hailed by some as a savior who would streamline operations, his ownership became the prime exhibit for critics of activism. To pay down the massive debt from his leveraged acquisition, he sold off TWA's most valuable assets, its lucrative landing slots at prized airports like London's Heathrow and its key routes. He ultimately took the company private, profiting handsomely himself through management fees and asset sales, while the airline, stripped of its crown jewels and saddled with debt, became a shadow of its former self, limping along for years before eventually declaring bankruptcy multiple times. For his critics, TWA is the quintessential example of an activist destroying a company's long-term viability for short-term personal gain, a predator killing its prey. Texaco, the green mail masterpiece. In the late 1980s, Texaco was embroiled in a catastrophic legal battle with Pennzoil, having been ordered to pay a staggering $10.3 billion judgment. The uncertainty had crushed its stock price. Icahn, the opportunist, saw not an oil company, but a fortress balance sheet under siege. He built a large stake and began agitating for change, threatening a proxy fight. Texaco's management, utterly distracted by its existential legal woes, simply wanted this new agitator gone. They capitulated quickly, agreeing to buy back his shares at a substantial premium. Icahn walked away with a profit of over $500 million for what was essentially a few months of aggressive posturing. It was a stunning, clean example of the pure financial power and profit potential of greenmail, a tactic now largely extinct due to regulatory changes and poison pills. Netflix, the modern catalyst, and the Icahn lift. In the modern era, Icahn brilliantly adapted his strategy to a new, tech-driven market. In 2012, he took a significant stake in Netflix when its stock was in a deep, seemingly terminal slump following the botched launch of Quickster and subscriber outrage. While the world saw a broken narrative, Icahn and his son Brett recognized the immense foundational value of its streaming platform and its first-mover potential for global growth. He quietly built the 10% stake and began pushing for a strategic sale of the company to a larger player like Microsoft or Amazon. While a sale never materialized, his involvement itself was the catalyst. The Icahn lift. The market's acknowledgement of his shrewd eye, combined with the credibility his investment lent to Netflix's recovery story, helped reignite institutional investor interest. The stock began its historic, multi-year ascent. Icahn eventually sold most of his position, netting a profit estimated at nearly $2 billion. This trade showed that in the modern era, his mere presence and his seal of approval could be the catalyst for a re-rating, even without a bitter, drawn-out proxy fight. Part 4. The Philosophy and the Legacy. Shareholder Champion or Corporate Destroyer. Carl Icahn's long and turbulent career forces us to confront difficult, unresolved questions about the nature of capitalism, corporate purpose, and the rightful distribution of power in the public company. The case for Icahn, the shareholder's avenging angel. From this perspective, Carl Icahn is a heroic, necessary, disruptive force. He is the ultimate agent of accountability in a system prone to managerial capture. For decades, he has been a one-man check against a corporate culture of entitlement, waste, and unaccountability. He argues, with compelling evidence in many cases, that by forcing bloated companies to focus on their core mission, return excess capital to shareholders, and operate with lean efficiency, he makes the entire American economy more productive, dynamic, and competitive. He vociferously believes that maximizing shareholder value is the supreme, legally mandated goal of a corporation, and that management are mere employees, stewards who work for the owners, not feudal lords. His supporters, including many institutional investors, point to the hundreds of billions of dollars in value he has unlocked for pension funds, mutual funds, and individual investors who rode the stock price increases he catalyzed. In this view, he is a necessary, if abrasive, corrective to managerial incompetence and arrogance, a warrior for the rights of capital. The case against Icahn, the myopic, short-term predator. The counter-argument is powerful, persistent, and underpins much of modern criticism of shareholder activism. Critics contend that Icahn's obsession with immediate shareholder value is destructively myopic. By demanding massive stock buybacks, special dividends, and quick asset sales, he forces companies to sacrifice long-term investment in research and development, capital expenditures for future growth, employee training, and product innovation. He is accused of enforcing a pernicious quarterly capitalism, pressuring companies to juice their stock price for the next earnings report at the expense of their future health and competitive moat. The story of TWA is the canonical example of a company being hollowed out. Furthermore, his enormous personal profits, whether from greenmail or successful raids, lead to accusations that he is not a true owner-builder, but a financial mercenary, extracting wealth like a mining company extracts ore, without building anything of lasting substance or caring for the ecosystem, the employees, communities, and long-term stakeholders. Icahn's own unapologetic defense, the Icahn lift, as justification. Icahn is utterly, famously unapologetic. He dismisses his critics as apologists for a failed, clubby status quo. He coined the term the Icahn lift, the immediate, often double-digit percentage jump in a company's stock price that occurs the moment his investment is publicly disclosed. To him, this market phenomenon is not evidence of manipulative hype, but irrefutable proof that the efficient market agrees with his assessment that the company was poorly managed and undervalued. He argues he is not a short-term thinker, but a value investor in the truest sense, who identifies deep value that others cannot see, precisely because it is trapped behind bad management and poor capital allocation. He sees himself as a revolutionary, a corporate Paul Revere, fighting a corrupt system that protects underperformance and management entrenchment at the expense of the true owners. Part 5. Timeless Lessons from the Raiders Playbook. Regardless of one's moral or philosophical judgment of his methods, the 5-decade career of Carl Icahn offers profound, gritty, and enduring lessons for any student of markets, business, power dynamics, and human nature. 1. Capital has a voice, and silence is complicity. The most fundamental lesson is that ownership carries not just risk, but responsibility and latent power. Most investors are passive. They buy a stock and hope management does the right thing. Icahn demonstrates that if you are an owner, you have the right, and some would argue, the fiduciary duty to your own capital, to demand accountability and performance. He embodies the principle that capital is not meant to be passive. It is an active, aggressive force for change and return. 2. Inefficiency in governance can be a greater source of profit than mispriced assets. While most investors look for statistically cheap stocks or wonderful growth stories, Icahn looks for mispriced corporate structures and governance. His unique edge comes from identifying the wide gap between a company's current operational value and its potential value under optimal management and capital discipline. This teaches us to look beyond the standard financial ratios and to critically analyze the quality of management, the board's alignment with shareholders, the corporate bylaws, and the potential for a catalytic event to close the gap. 3. The decisive power of a concentrated, high-conviction, catalytic bet. Unlike diversified fund managers who hide behind benchmark indexes, Icahn typically runs a highly concentrated portfolio of fewer than 20 stocks. When he finds a target, he takes a massive, game-changing stake, often becoming the largest or second largest shareholder. This concentration is not reckless, it is strategic. It gives him the leverage, the voting power, and the credibility to wage his campaigns. It is a masterclass in the power of putting significant, decisive capital behind your very best, highest conviction ideas, rather than diluting your influence and returns with a basket of mediocre ones. 4. Asymmetric information and the supreme value of stealth and surprise. A key component of his historical success has been his ability to conduct deep, quiet research and accumulate a position before the market is aware of his interest. This creates a massive informational and cost advantage. For the average investor, the lesson is the timeless value of doing your own deep, independent, and contrarian research to find misunderstood or overlooked opportunities before they become popular consensus and fully priced. Be the hunter, not the herd. 5. Understand the psychology of your opponents, fear, ego, and entrenchment. Beyond the numbers, Icahn is a grandmaster of human psychology and corporate politics. He intuitively understands the fears and motivations of corporate managers and boards. They fear public embarrassment, messy lawsuits, loss of social status, and, ultimately, loss of their lucrative positions. He expertly exploits these fears. The threat of a public campaign is often more potent than the campaign itself to achieve his negotiating goals. This translates to a universal lesson. In any negotiation, competitive situation, or effort to drive change, understanding the psychological drivers, insecurities, and incentives of the other side is a critical, often decisive component of success. In conclusion, Carl Icahn is a complex, contradictory, and colossal figure, a living monument to a particularly aggressive form of American capitalism. He is the ultimate outsider who violently barged his way in to become the ultimate insider, the shareholder advocate who was accused of shareholder exploitation, the corporate destroyer who claimed to be the only true corporate builder. His career is a 50-year-long, real-time laboratory experiment in the application of pure, concentrated financial power and unwavering will. He forced a fundamental, irreversible reevaluation of the relationship between ownership and management, and in doing so, he permanently altered the DNA of the American corporation, for better and for worse. He forces upon us enduring questions with no easy answers. What is a corporation for? Who does it truly serve? Is the relentless pursuit of shareholder value the highest good? Or does a great company owe a debt to a broader constituency, its employees, its community, its country, and its own future potential? Icahn's life provides one forceful, uncompromising answer. The modern corporate world, with its intense focus on stock buybacks, constant pressure from activist investors, heightened board accountability, and the ever-present threat of being Icahn-ed, is a world that Carl Icahn, more than any other single individual, helped to create and define. He is the original corporate predator, a role he carved out for himself with bare hands and relentless ambition, and in whose formidable, controversial footsteps many now follow. He is a living legend, a polarizing force of nature, and an undeniable, indelible architect of the modern financial age. Thank you.